to begin with, and then what the steps are as you're moving through the process. So I'm just going to hand it over to Mike to start explaining that, what a construction loan is.
Thank you, Renee. A construction to permanent loan is a little bit different than a standard purchase. And there's two types of construction to permanent loans. You've got construction to permanent loan where you're rolling the lot purchase into the loan. And then you have a construction to permanent loan where you own your lot and you're going to be doing a tear down on that lot. And I'm going to cover both of these initially, and then we'll generalize together. If you are rolling the purchase into the lot purchase into the construction loan, we do a one-time close where you close on the lot and you close on the construction loan all at once. So with us, you're a one and done. We afford you the opportunity to lock into a 30-year fix, 15-year fix, 5-year, 7-year, or 10-year ARM right up front, right now within 90 days of the close of the construction loan, which is done up front because you have to pay the lot off so that the builder can start construction and we can start paying the builder. For a tear down, the loan programs are the same, 30-year, 15-year, 5-year, 7-year, or 10-year ARM. This is where you own the lot already. You may be living in a house on the lot and you're just going to tear it down and build. Same thing. We're going to close on that construction loan. We're going to pay off your mortgage and roll it into the construction loan. Now, on both these loans, you're paying interest only during the construction period, just on funds that have been drawn out. So typically, even though interest rates are a little bit lower than this, on a 3.5% 30-year fixed mortgage, for every $100,000 that's drawn out, it's going to run you about $292 a month, just to give you an idea. So in essence, you literally have a full year or more without a full mortgage payment. You are responsible for the county taxes that exist on the property as it sits, not with the improvements, but as the property sits now. So you'll be paying that typically every 6 months, depending on where your lot, what county your lot is located in, directly to the county. Then at the very end, when your house is completed, there's no second closing. The interest rate and program that you locked into more than a year ago, we will do a simple conversion. Whatever that rate and program was, we'll send you out a conversion package. Once the builder has completed the project, you will sign the package, send it back with your escrow should you decide to have escrows. Then you will begin making your full mortgage payment. There are no second closing costs. There's no second appraisal, no updating the file. As I said, with us, you're a one and done right up front. And that is about a 5,000 foot level view of what a construction to permanent loan is.
Important when we're thinking about when they close, the different loans, and I think Mike will go into that a little bit later, depending on if it's a tear down or a purchase of a lot. The parameters for closing are a little bit different as far as timeframes are concerned. And obviously we can answer more detailed questions if you have specific ones personally one-on-one. But I think Mike's going to probably go into that briefly as we walk through this process a little bit. The first thing, obviously, Mike, that I have all my clients do when I speak with them is, number one, reach out to you and get a pre-qualification. And that pre-qualification can be whatever they're comfortable with. So they pre-qualify for a $5 million loan. That doesn't mean they have to say, Renee, I can afford $5 million. They can tell me the budget that they want to spend. What that does is allows me to be able to guide them through the process, what kind of house they want, what kind of options they want, and better, make sure we're trying to stay in those parameters. So, but the pre-qualification, there's always questions on what can I afford? What sort of down payment will I need? So I was hoping, Mike, you could go into some of those things for the pre-qualification and what you talk about when you have that initial conversation with folks.
Well, the first thing I'm going to do is send you out information based simply on what I just previously discussed on what a construction loan is. I have a construction FAQ sheet that I've done up over the years of most asked questions that borrowers find very informative. And if you read that, you'll be well ahead of the game. The next thing I'm going to do is send you a link to my website or do a phone application with you, preliminary, no obligation, to give you an idea of what you do qualify for. So before you sit down and talk to the builder and really get specific about the numbers, it's very important that you know all the costs that are involved. A construction loan, being a hybrid loan or not a standard loan, does have costs that you don't incur on a standard purchase, such as draws, title bring downs, things like that, that add a little more to the cost. And you need to know what all these are. The qualifications from a debt ratio standpoint, income standpoint, asset standpoint are also a little bit different. So you may have a pre-approval or a pre-qualification or a standard purchase, but that doesn't necessarily mean you're going to qualify for construction. So that is one of the most important steps that you can do, is to find out what your budget is, find out what the reserves may be, find out the amount of cash or funds that you need to have on hand before you really sit down and talk to the builder. But we're going to go over all that. You don't necessarily need to have a number in mind, because when I do a qualification, I take a look at your financial profile. I'm going to give you that number. I'm going to give you a maximum. And I have some people that come to me and they say, well, this is what I want to pay on a monthly basis, all in, once I start paying my full mortgage payment. So there's a number of different ways I can qualify you, but it is very important that I take a look at that information. I do like pulling credit because I can't issue a pre-approval letter without a credit profile as well. And that's something that typically, depending on what day of the week you get me the information, I can usually turn around in 24 hours for you, sometimes quicker.
And a quick thing, I just want to interrupt real quick, Mike, on that credit pull. Does that go against them as far as their credit score?
Yeah, it's a hard pull and it's going to be an inquiry. Um, Typically, it really depends. Now, a mortgage credit report is different from a consumer credit report. You will find a mortgage credit report uses a different modeling, and it's usually always going to be lower. The scores are going to be lower on a mortgage credit report than it will be on, let's say, a consumer credit report that you pull online from a third-party vendor, so to speak. So yeah, it's usually about a 3 to 5 point hit on the score. Now, if you were to pull, let's say, 3 mortgage credit reports within typically a 2-week period, it's only the first one that's going to lower your scores. That is the way it is currently. That, of course, is always subject to change. So keep that in mind when you go out there and start shopping.
Okay, good to know. The other thing I wanted to know, Mike, is when we're talking about the down payments, I know that they vary quite a bit. Some clients that have a lot of equity in their homes, and they live in the property that they're going to tear down, often don't have down payments. They have to put cash up. While others may have 20%, 25%. What is the average for someone that doesn't have a lot of equity or is purchasing the lot that you see percentage or see down payments at?
Well, 2 different scenarios. Number one, if you're purchasing the lot, your down payment is going to be based on what we call the total acquisition cost. The total acquisition cost is going to be the sales price of the property plus the cost to construct the site work. We will do a 10% down loan to $1 million. That's loan amount, not purchase price, but $1 million. We'll do a 15% down loan to 1.5 million and 20% down to well over 2 million. And that's on a 30-year fixed, 15-year fixed, 5-year, 7-year, or 10-year ARM. Now, remember, that's on the entire project price. If you own your property, and for example, let's use a case in point. Let's say you have a home or you live in Pemmon Hills, and let's say that you owe $500,000 on your house. And the builder comes in, NDI comes in and says, okay, we're going to do a $700,000, or let's say $600,000 all in cost to construct the site work. So that puts you at 1.1. If that home appraises around, and it could be Pemmon Hills or anywhere, if it appraises for, so that you've got 15% equity in it. So if we're looking at let's say, for example, a 1.1 loan amount, yeah, so you're looking at an appraisal somewhere in that area of about 1.3, give or take. And in situations like that, you may not need a down payment at all. Of course, the 20% equity in the property, because we're going to base your equity position on the full-blown appraised value of the as completed product. All right. So once that builder's done, it's going to be as though we're already completed, but we're going to base it off of the initial plans and specifications. That's how we're going to do the appraisal. Not going to be on the house that's sitting there. That's going to be torn down. It's going to be on an as completed product. So I have many, many, many borrowers that come in a situation like that, zero down payment, they roll in their closing costs, and in some cases, and in many cases, we actually pay the builder the deposit. So now, as again, that occurs quite frequently. Some people need a down payment to qualify, but if you don't, and the equity's there, you'd be amazed how little you can get into these properties.
Yeah, I think that's why it's really important to take this step so early, because a lot of people don't, it really gives them an opportunity to get a clear picture of their individual circumstance. So everyone has a little bit different situation, and I like how you can back out of get them the number that they want, either what they want to pay per month, what they're comfortable with, or what they just want to spend overall on the project. So yeah, I think it's a critical first step for people to take. And it's something that can be done in tandem in talking with our team, so that they can get a good understanding of what components go into the budget. Renee can walk through all of that, and I think having that conversation with you on the pre-qual, it all just kind of starts to really paint the picture of what it will look like financing wise. So.
Yeah, and some people, touching back on that, Mike, with the financing, what can be involved in the financing as far as down payments can be financed, permitting fees can be financed, all of that stuff can be financed. There is a little nuance in that as far as when the loan's going to close and when we can get started on planning and all of that. But so that is a possibility to finance all of that, all of the pieces. Some people do pay some of those things cash to keep the process moving without having to close the loan. But that's something we can talk about as we're moving through the process. And locking the rates. I mean, that's such a great thing that Citizens offers, is allowing the clients to lock like today's rates for the end of the year when the house is complete. So if the rates are 5% at the end of the year, you still have your 3.25%.
And you can actually go out as far as 18 months. And a typical standard construction term is 12 months from the day of closing to conversion. You can go 15 and 18 months as well.
Yeah, I think that
which I do recommend for a straight purchase.
That program was.
Say it again now, I'm sorry.
I said that program was really unheard of until recently, in the last,
Correct.
I don't know, 5 to 6 years, Mike? Mm-hmm. So.
Less than that.
Yeah. I say all the time, when I built my house back in 2008, I didn't know what my permanent financing rate was going to be until the house was 2 months from completion. So, when you're starting out planning and going through the planning process and construction, to have that peace of mind of knowing exactly what your monthly is going to be, I think is really awesome. In 2008, for the financial markets, you remember that was not a good year. So, we were, at the edge of our seat waiting to see what would happen once we were done with the house. So, but yeah, it's an awesome program, Mike.
Mike, I think we can, honestly say that the pre-qualification is a really important part of the process for us to move forward with the talking about the building and the overall cost of everything. Let's say a client is ready to move forward and they are ready to write a contract with NDI. What is the next step for you as the lender? What do you need to do next, or what do you need from the client next, or from us next?
Well, hopefully by the time that they're ready to write a contract with you, they've already been to me. They know what they're qualified for. They know what the costs are going to be. So I have what's called a preliminary application from them. Now, depending on their employment scenario, depending on their financial profile, a lot of times I'll get information up front before I'll even issue a pre-approval letter. for folks that are self-employed that may have a number of investment properties, rental properties, et cetera. I'll get your taxes for the last 2 years, profit losses, things like that. But these are all things that, that we need up front to really give you a good picture. So they've already come to me. Now you do your contract with New Dimensions. I get the contract from New Dimensions. Then New Dimensions follows it up with the plans. And I have to say, in all the 23 years that I've been dealing with New Dimensions, they really are one of the most efficient builders I deal with, if not the most efficient. I never have to wait for plans very long because I need the contract from the builder and the plans and specs to really, really get started, to get the appraisal done and to get the borrowers down the road, toward closing. With a purchase contract where you're purchasing the lot, I need the lot contract, the builder contract, and then the plans and specs as well, which typically come about 2 to 3 weeks after the contract's written. And that's very important. Now, when you do a lot purchase, you probably don't want to get started on anything until you own that lot. So we talked about extended locks. In that particular scenario, you definitely want to do an extended lock. I'd recommend 15-month in this particular environment, as Renee and Jennifer can tell you, because of the time frames that we're looking at for permits, especially on a lot purchase. So anyway, the time frame from now, at this particular point in time, is taking about 60 days from start to finish. And a lot of that's due to loan volume, as far as the volume that's coming in because of the lower interest rates have been for the last year, although it has subsided some. And I'm hoping as we go into 2021 that we've put a lot of systems in place to handle the additional volume. But it's still it's basically a 7-day-a-week job for our underwriters, processors, and me as well. So it's a lot of volume. Just be patient. We will get you done. But you're going to know up front, right at the beginning, how things look. I can't remember the last time I've lost a borrower for a rejection, unless something came up at the last minute. So with me, you're going to be in pretty good shape. I haven't been doing this for almost 36 years. So, and a big part of that, dealing with the folks that you're talking to right now.
And those dates of closing, 60 days, that's a good thing for people purchasing the lots to know that, you're looking at 60 days out when you're writing a contract on a lot to get, well, we might even need a little longer, I guess, Mike. If it's 60 days for the lender, we need to get the contract together and the plans to you prior to that. So, it could be 60 to 90 days that's going to be needed to get this loan from, beginning to closed, which means if you're purchasing the lot, we can do some upfront stuff, but if you want to finance everything into it, we need to talk about those timeframes. Every client's a little bit different, so everybody has a different scenario. So when I get into this process with a client, just need to talk it through. We need to look at the timeframes. We need to look at what their plan is as far as purchasing the lot, and get with Mike and find out what the timeframes are with them and what he suggests as far as moving it forward. So there's a lot of, go back and forth between the lender, myself, and the client to make sure that we're moving this forward properly, not holding anything back, but also not giving timeframes that aren't going to work. So it's really important that we all have an open conversation.
And understanding too, Renee, I think just so for the client's benefit, understanding the things that can be done in tandem and what conversations and activities can be done while we're waiting for the loan to close or, to get that set up so that timing works out perfect.
Yes, absolutely. As far as loan closing, Mike, I'm assuming that, you could go into a little bit of, let's say, the last few days. Obviously, we know that it's going through appraisal process. We know that it's going to the underwriter. In those last few days before closing, there's a lot of contacts between the settlement attorney, between you and the settlement attorney, the homeowner possibly, just getting everything finished and making sure you have all the documentation you need to close this loan on the date that we want it to close. Is there anything that you think is important to mention to people at that point. I know that we've already locked our interest rate, so that's not a thing. Is there anything in those last few days that is important to know?
The more changes you make after that appraisal is ordered, the more you will delay the process. I encourage you as borrowers and as customers of NDI to be as certain as you possibly can to some point as far as your major changes. Make them up front. NDI will build in allowances for you, as far as the different things for cabinets, flooring, countertops, whatever. But once I order the appraisal and the appraisal's back and I get change orders, those change orders have to go back to the appraiser. It is imperative that what we finally close with is exactly what we have in front of us from a contract and exactly what was submitted to the appraiser. So when you change the cost to construct, either moving it up or down, prior to closing and after the appraisal's done, it has to go back to the appraiser. So be careful of your change orders. Once you close on the loan, you cannot increase or decrease your loan amount. I will also caution you that once you close on the loan, do not take anything out that the property was appraised with. That could change the entire structure of the loan and trigger a reappraisal at the very end if the property is not built according to the plans and specifications that the property was appraised at and closed on. Anything that you add after the loan closes, you will have to pay for in cash directly to the builder.
And I think, not to scare everybody where you can't make changes, but I think when Mike's talking about, he's talking about things that affect the appraisal of the house, changing your tile selections or your granite selections or your cabinet colors,
That's not going to affect, correct.
Yeah, those aren't going to affect anything. He's more talking about, maybe a detached garage and then all of a sudden you decide not to have it, or a finished basement and then you decide to pull it out. Those kinds of things that really are going to affect the square footage or what the appraised value is going to come in at. So, and we'll talk about that, as we're going through this process to make sure that we know structurally, especially, or major upgrades are included in the price in the contract up front. And if we can't include exact costs, which we try to do, we'll include allowances like Mike was saying. Another thing, Mike, that you often do is have a contingency in the loan. Is that correct?
That is correct. If you own your lot already, and if the appraisal allows, I usually recommend building in a contingency reserve. A contingency reserve is funds that can be used for additional options after closing. They can be used for site work, cost overruns if they exist. In all the years I've been doing this with NDI, the cost overruns have, I can honestly say, to my knowledge and to my remembering, never been with NDI. It's always been in site work. Things that have happened that, that wasn't particularly planned for. But they can be used for that. That's contingency reserves. Now, if you increase your loan amount up front and don't use it, we're going to lower your principal balance prior to conversion. So remember, you don't pay interest on anything that you don't use because the interest is based on dispersed funds only. Now, if you're buying a lot and you're rolling everything in, the only way to do a contingency reserve in that aspect is if NDI builds it into the contract and it's in the draw schedule. So it's actually built into the cost to construct. So it's the only way to do it that way. But I think you'll find that, and I have found this over the years, that the allowances that NDI puts in are 99.9% of the times adequate for what you're trying to do, based on my experience.
Yeah, I think that contingency is really good. I think some people might feel more comfortable paying out of pocket for anything that might come up. But I know when we talk to people, especially as it pertains to site development costs, that, we encourage them. If you don't feel comfortable paying out of pocket, then let's build a little bit more into what the potential site cost might be. Because like you said, if it's not needed, then it's not drawn or not spent. But if it is needed, it's there. And we'll get more, our next session is actually going to focus solely on site development, which is really, I think, in all the parts of our process, probably the one aspect that people have the most questions about. So I think it's going to be a really good session. But yeah, I encourage people, if you don't feel comfortable paying out of pocket for incidentals or for something that might occur on the site that is unknown at the time that you close your loan, then I think the contingency is really a great thing to work in. So
you know, at this point, Mike, you know, I think this is a good overview of what we were thinking, you know, what we needed you to talk about. I know it's a lot of information. The financial aspect of it is all different for everybody. So that's why we encourage you to speak with the lender first so that you can understand that. It's, you know, it's obviously the key to the building process. So we really need to understand that part before moving forward with anything as far as pricing and stuff is concerned.
yeah,
It's
a great first step. I mean, it really, like I said earlier when we were starting, I think it just really does a good job of painting the picture from a financial standpoint for people so that they know, you know, what that's going to mean for them, not only during construction and the interest payments during construction, but also once they move into their new home, what it looks like on a monthly basis. So I think it was a great overview. We have some awesome questions that have come in. So Mike, unless you have something else,
I'm good.
jump into the Q&A. So just a reminder, I do have some questions that are coming in. And then if you would like to ask a question, please just drop it in the Q&A or in the chat, and we'll get to those as well. So I get this question all the time, Mike, and so I thought maybe you could touch on this. But the difference between construction loan rates and traditional mortgage rates, how do those look when you're comparing the two?
Yeah, you're going to find that a construction loan rate, because of the amount of time that we have to guarantee the rate, is always going to be higher. And then how high it is versus normal, you know, like a regular 30-day purchase rate will really depend on the loan to value and credit scores. If you were to go out to a builder right now and do what I call a turnkey, in other words, you say, Mr. Builder, I want you to build me a house, not a construction loan, but I want you to build me a house and it'll be ready next year at this time, but I want today's rate. Okay, well, we quote 13 different rates for every program. So in order for you to get today's rates on a construction loan or a turnkey, as I call it, you're either going to pay a fee or you're going to pay a cap, what we call a cap float down, where the rates are going to be capped at a certain, you know, it could be a half a point, could be 3/4 of a point or whatever above current market. And then if the rates are lower within a 30-day period of time, you know, at that time you float it down. So that's on a standard purchase. The construction to perm loan is a portfolio product. It's not a Fannie Mae, it's not a Freddie Mac product. It's a portfolio product. It's our money, Citizens Bank, and anyone who does a construction loan, typically it is a portfolio product if it's a one-time close. So yes, you will find they are a little bit higher. How much higher? If you're doing a purchase, typically, again, we quote 13 different rates, but I would say on average about a 1/4 point, you know, maybe 3/8 of a point higher. Again, that's assuming 20% down or more, whatever the case may be. But yeah, they're definitely higher because the amount of time that the mortgage company has to guarantee the rates for. And the further that mortgage company goes out, the more expensive it'll be. Those are basically called hedging costs.
Yeah, the maintenance of it is also a lot different. I always tell people, you know, when you're going out and taking out a conventional mortgage, that's like a one and done.
We're one and done.
And, you know, with a construction loan, the maintenance that has to occur between the lender, the builder, the title company, that is, you know, it's multiple steps to that. NDI takes 5 draws throughout the process once we start construction. So, you know, each time, obviously the lender is involved in that. And so that, you know, tends to make the product more expensive than just a conventional loan. So
yes, I'm involved in your loan.
That.
Yeah, I'm involved in your loan from the time I meet you until you finally get into that house.
Yep.
So, and we have a draw department that does nothing but the draws. The construction loan is very labor intensive. We have to deal with the builder. We have to deal with the title companies. We have to deal with some of the vendors from time to time. And so it's, it is labor intensive without a doubt.
Yeah. So our next question is, I think, really timely because I know in our space and on the construction side, we have definitely seen an impact of COVID. The obvious, of course, being, on our individual lives, but also during, with construction. So, but this question is specifically geared towards the impact of COVID on construction lending. I know we talked a little bit about closing times earlier and that you need, about 60 days to get something closed. What other impacts have you seen on construction lending due to COVID?
Well, I think one of the biggest impacts on construction lending is some of the guidelines had tightened up, but they've also, some of those have been relaxed as we've gone into it. The guidelines that have tightened up the most have been on some of the self-employeds as far as what's required, because a lot of the self-employed folks were the ones that were most impacted by the COVID. Also, we're running into supply chain issues as far as the amount of time it's taking to get the materials to build your house. And we've been we basically, if folks have been running over and it is COVID related, then we've been granting extensions at the end without cost. In some cases, it's on a case-by-case basis. So it has definitely impacted. It's getting better, but you've also seen a slowdown in the amount of time it takes to get permits as far as the permitting process with different counties, and that varies from county to county. As I tell the people here, I think a lot of folks have really learned to work good from home and from remote locations. But then again, a lot of folks haven't. So yeah. Anyway, I think there's a lot of factors going in right now.
Yeah, we, from a material standpoint, obviously the biggest surprise is when we place an order and we're then told at the time of ordering that the delivery time has been delayed. But, what we've been able to do as a company is obviously identify those materials that are on delay and adjust our process to accommodate that. So that has allowed us to really limit the impact of it. Windows have been a thorn for every builder across the country. We use Simonton windows, which are actually manufactured here in the United States, but a lot of the parts that they depend on come from overseas. So something that was a typical 3 to 4 week lead time, I was told 2 days before Christmas, was now going to 13 to 15 weeks. So, at that time, it's really difficult to react like that. But, since we had that information, we've been able to adjust our process, and which has limited the impact on our clients. So it's been interesting. So it actually took a little longer, in my opinion, for that impact to reach us. So, it's just constant management and communication with suppliers that is key. So, so the other question that we got, we just received, and you could maybe elaborate on this a little bit, Mike, is do we lock the rate of the perm loan when we lock the construction loan or at conversion at the end?
With us, you lock it at the beginning. You can lock it in up to 90 days prior to the close of the construction loan. And remember, a construction loan is closed right up front. So if you do your contract today with NDI, we have the plans and specs, close you in 60 days, you could lock right now. And that's going to be your rate through construction, and that's going to be your permanent loan rate. That's what you're going to convert to. There's no guesswork at all involved in that. With us, as I said, you're a one and done. That's going to be your construction loan rate. That's going to be your permanent rate.
Yeah, and that's, not every lender offers that program. So I've said it before that I just think the program that you offer, Mike, is really, it's progressive, and it really is it's unheard of. So, I'm really glad that you guys have been able to bring that to the market. All right, another magic question. People want to know what's going to happen with mortgage rates this year.
Well, the one thing you've got to understand, in all the 36 years that I've been doing this, I've never seen rates as low as they were last year. They have started to tick up a little bit. I get reports every day. I call them crystal ball reports as far as what they think the market's going to do. The last report I read this morning was the fact that the stimulus is going to have a negative impact on rates. It's going to drive the rates higher. I think rates are going to go higher regardless. You can't stay in this particular interest rate range. And you have to understand, regardless of what the Fed does, that really doesn't drive the rates to a large degree. But I think rates, there's a lot of volatility right now going on. There's a lot of uncertainty, and uncertainty is not always good for rates. So do I think they're going to go up dramatically this year? No. Do I think they're going to go up? Yes, I do. I think you're going to be in that. My crystal ball says that, you know, for portfolio product, construction loans, et cetera, I think you're going to be in that. This is 20% down, give or take, 20% equity. I think you're going to be in that 3.5 range, maybe 3 5/8. We're not quite there yet, but I think that's where it's going. The bond market's been off negatively over the last several weeks. It's come back a couple of days, and it goes off again. A lot of volatility. So I think rates are definitely going to go up because they just can't stay as low as they have been. We've already seen them start to move in that direction.
Yeah, well, and I won't tell people how long you've been in this business, but still, even at that increased rate, it's still such an, I mean, it's it's still unprecedented in terms of when you look at the last 30 years. What my interest rate was when I built 13 years ago, I mean, it's just that just from an affordability standpoint, really is beneficial for buyers. Someone asked, they had sent in a question, which I think is a really good topic and a good segue from what we were just talking about, which is why financially it's still a good time to buy. We have seen material prices edge up over the last 12 months, especially lumber has been really, I'm sure everyone's heard about it in the news, and we're obviously keeping a close eye on things. But, maybe I'll pitch this one to you, Renee, is why, from a financial standpoint, is it a good time for people to jump in and do this right now?
Well, I mean, I've been doing this for almost over 16 years, so this is my 17th year with NDI. I never see the prices of construction go down. I mean, it just doesn't happen. I get that lumber prices spike and drop and spike and drop. But overall, it's not just the lumber pricing that's going up. I mean, salaries go up, which means that's, our contract, our subs, want more money every year to pay their employees. Again, material costs, but also site development costs. I've seen that increase so much since I first started. So it doesn't seem to go down on a yearly basis. We're not up and then down. So I feel like I've had clients that have waited years, well, I'm going to wait a few years, save some money. But by the time they do that, the prices increase so much, whether, like I said, it be the overall building or site development cost, that it wasn't necessarily worth it for them to wait. And I've had clients come back to me and say that I should have just done this 5 years ago. I should have done this 2 years ago. So I just don't see it go down, and things keep moving forward. So hopefully.
I think you make a really good point too on the site development, because I mean, you and I have been doing this for a long time, Mike, you too. And those costs are really driven by county requirements. And we find that, every couple of years, those county requirements get, more and more, I won't say stringent, but just they expand, which, it just piles on to the cost of site development. So I think that's a really good point for people to consider. And also with, the potential of rising cost of interest rates, I think it all goes hand in hand. So, but you're right, I mean, we look back, over the history of NDI, and, just because of the nature of the industry, things just every year just gets more and more expensive to build. So, it won't be less expensive. So, I think we can, based on, the industry and the history, I think we can say that with confidence. So, the other question that we got submitted, Mike, was what does the loan product look like for Citizens Bank in the near future? So do you see either your programs changing or pulling back, or what do you see in terms of what you guys are able to offer?
That's a very good question, Jennifer, because I see what other banks are doing with the construction loan over the last couple of years, and they've actually, the restrictions have grown. I see more banks that have dropped the loan to value as far as what they're doing. In other words, 75%, one major competitor last year went to a maximum 75% up to $1 million. So we're going the other direction. The restrictions have mounted. I have found throughout the industry, but I can honestly say I've been with Citizens over 7 years, and we have not gone in that direction. We have not gone in that direction at all. The my mortgage insurance companies have tightened up a little bit, but that's not Citizens, so we have to follow some of their guidelines for folks who do have the putting less than 20% equity in the property. But other than that, we have not changed our guidelines for the worse. Actually, we're actually going to be improving some things after March 1st. I don't want to say anything what they are until I actually see them, because as I was told, they have to change some things in the system and IT, and changing the reprogramming takes a little time. So the outlook is good here.
Yeah. Well, I know you'll keep us up to date on that stuff. You're always good at
I will.
making sure that we've got all the most current information about what you guys are able to offer. So that is the last, just making sure I'm not missing anybody here. Yeah, that is the last of the questions. So, I just want to thank everyone who attended today, and just encourage you, if you're just starting this process and you haven't spoken to a construction lender, to reach out. And when I have questions about construction lending, I call Mike. He's got a lot of experience, and I think he just does a really great job of explaining things and guiding people through the process so that they can get exactly what they want and is best for their family. So Mike and Renee, thank you for your participation today. I thought it was great. This has been recorded, and we also have a recording from the first session. So if you would like to receive a link for that, just let us know. Renee will be doing some follow-up with you. And obviously, if you need anything or have any questions about building, have any questions about NDI, please reach out to us. I'm always available, as is Renee. And we just really appreciate your time today. So Mike, Renee, I hope to see you soon. Y'all take care.
Thanks.
Thank
You
you.
too.